My name is Grace Lee, Associate Professor of Accounting and Taxation at the Gabelli School of Business. I'm here today to talk briefly about one of my research publications titled Express Yourself: Why Managers' Disclosure Tone Varies Across Time and What Investors Learn from It. I have always been interested in looking at what information reflects firm risk and whether investors actually incorporate that information when they assess the risk of the firm. One of the channels for managers to communicate with investors about their firms is through disclosures. These disclosures include not only quantitative information such as accounting numbers, but also qualitative information about future prospects of the company and risk factors faced by the company. Let me talk a little more about qualitative disclosure, which are the focus of our paper. So not all qualitative disclosure content is neutral. Some words convey positive information and some words convey negative information. So let me give you some examples. Achieve, improve, efficient, profitable are considered words conveying positive information, while restated, discontinued, litigation, and decline are words conveying negative information. Prior research uses this disclosure tone and finds that positive disclosure tone is linked to positive future firm performance. So my co-authors and I wanted to know whether this disclosure tone contains not only information about firm performance, but also information about firm operating risk. So our idea was that if disclosure tone is volatile, then it likely reflects that the firm's underlying performance is volatile across time. Therefore, by looking at the volatility of disclosure tone, we can capture information about firm operating risk in disclosure tone. If this is the case, then we wanted to find out whether investors actually use this operating risk information in disclosure tone volatility when they assess the risk of the firm. So then how do we test it? We extract disclosure tone from firms' 10-K filings, 8-K filings, and quarterly conference calls. We then measure the net disclosure tone by taking the difference between words conveying positive information and words conveying negative information. After that, we compute the volatility of this net disclosure tone across time. Then what do we find? We find that managers' disclosure tone volatility provide incremental information about firm operating risk, which is not explained fully by quantitative measures of operating risk, such as volatility of cash flows and volatility of earnings. We then look at market-based measures of firm risk and find that firms with higher disclosure tone volatility have higher stock return volatility and higher cost of equity capital and higher implied option volatility, confirming that investors actually use this operating risk information in disclosure tone volatility when they assess the risk of the firm. So in conclusion, tone in qualitative disclosures is an important factor to assess firm performance as well as firm operating risk. So if you are an investor, don't just look at quantitative information, look for tone embedded in qualitative disclosures in order to obtain more information about a firm and understand the firm better.